a lot of spotlight was put on Nasdaq's strong performance. But bear in mind, the strong performance of this Nasdaq was really driven by just a very few number of mega cap names.
Like in 2021, where everything was performing, if you threw a dart on a board, you would probably hit something. But in a year like how 2022 has started, things are quite different, as you can see.
Hello, I'm Noelle Lim on ASEAN Speaks by Maybank IBG. A pain point that the investors face is picking stocks that suit their risk-return profile and is appropriate for the market cycle that we are in, and then having a good night's sleep. Maybank IBG has 24 portfolios modelled in different markets and seasons that you can refer to when making investment decisions. So far, 21 of our portfolios have beaten their benchmarks like the MSCI Malaysia and MSCI Asia ex-Japan. In this conversation with our portfolio strategists in Malaysia and Singapore respectively, Seng Yeow and Chan Han Chin, I will go behind the scenes to understand how Maybank creates portfolios. I will also discuss with them where the smart money is heading as investors are beginning to get out of high-growth tech stocks. Let me begin with you, Seng Yeow. Why did Maybank create these model portfolio seasons, or model ports in short?
Well, Portfolio Seasons was created with the mass retail segment in mind, particularly investors who are looking to start an investment portfolio. Now, there's a huge gap in the market. An investor can either try to construct the portfolio himself, or he can get a wealth manager to help build the portfolio. The first route requires a lot of time and effort to track the market, and it's never easy to optimize the portfolio for performance, especially if the client does not have access to the right optimization tools. The second route is to buy a wealth product such as a mutual fund. Usually entails some form of management fees which can eat into the returns, especially if the fund does not perform. Now, with Portfolio Seasons, first we predefine a series of model portfolios with different risk-return targets so that it's easy for clients to reference our model ports to construct their own portfolios. Second, since anyone can DIY a portfolio through online trading, the client does not pay for management fees beyond the standard brokerage commissions.
Why are they called seasons?
The name Seasons is because we have model portfolios that are built around risk-return profiles that are commonly used by wealth management industries. Growth, momentum, value, quality, low volatility, and balanced. These portfolios are generally quite well known within the market, and they all perform differently under different market cycles of bull, late bull, bear, and recession. So in short, there's something for every client for every season.
Your team currently runs 24 portfolios. Sounds like a massive effort by people with PhDs. Could you give us a sense of how these portfolios are constructed?
Well, to extend on the concept of buying a basket of stocks, effectively what the client is getting is diversification. So it is very important to understand that to get higher returns, one has to accept more risk, which means more price volatility in that sense. So since each model portfolio comes with different risk-return profiles, our task is to ensure that the right stocks are selected for each model portfolio and the stocks are weighted properly to match the risk-return or the expected return profile. So this is what we call the optimization process, which also includes backtesting.
If we just take one portfolio style, such as value, what goes into its construction?
Sure. Firstly, every stock has a pattern to the way that it trades. So we first try to understand its mean trading range and how much it swings from this level over time. After this, we determine how much of the stock we ought to buy to optimize returns. And finally, we look at the overall portfolio in aggregate and backtest to see if it has delivered returns.
Now, I'd like to discuss your outlook based on the projections that you are running in your portfolios. With interest rates going up and the Fed tapering in the horizon, Hanchin, will the stock markets crash this year?
The likelihood is quite low for this year because technically speaking, last year we have crash in the Chinese stock markets where Chinese stocks are actually already in a bear market, having fallen more than 30% from its peak. And of course, similarly on the Hang Seng index, it has also fallen 25% from its peak. this year we are already in a low base to start things with, when Chinese stocks are already no longer expensive. While in the US, corporate earnings are also looking quite strong. And of course, we will expect corrections from time to time, especially with the talks of Fed tapering. However, we think that a crash scenario of a significant magnitude is really quite unlikely, because firstly, we expect global markets to recover from the pandemic this year. And secondly, Asia ex-Japan's attractive valuations will provide a buffer against any significant downside risk.
The S&P 500 closed the year up 27%. While we don't expect stock markets to crash, the elephant in the room, I feel, is inflation. What's your view? Is it still transitory?
Well, let me take this question here, Noelle. The real threat here is that inflation is only just showing its ugly head. So as the economy reopens, labor, I'm talking about the US, labor is the key driver of inflation. And in recent months, there is much more evidence that wage pressures are actually rising in the US. Take, for example, the fast food industry, whereby they have to raise wages by 10% just to attract workers to come in. So no one is quite sure whether the workers, those who have exited the labor force during the pandemic crisis, are in fact coming back in the first place. So that's one. The other is that the surge, we also see a surge in housing costs, and the housing components represent 40% of the US CPI. The work from home economy is simply fueling more demand for real estate, and also in the suburbs. And that's a longer structural issue that we see. Another threat is that as companies anticipate inflation, they start building large price increases into longer term contracts, which also includes labor agreements. So that then also leads to a vicious cycle. Our macro research team still believes that inflation is transitory at this point. So if supply bottlenecks are the culprit, that will get fixed, right? But probably that will only happen after China eases its zero COVID policy. But inflation is structural. It could actually hang around for years to come.
When we say inflation is transitory, what time frame should we base our assumptions on for now?
I think right after the Beijing Winter Olympics, and hopefully we get some signals that they will likely that they will relax some of its policy stance regarding COVID and the lockdowns. Within a quarter or so, we should be able to see some evidence filtering through the data. Already, I think if you look at an index such as delivery times, that has improved, thankfully. So I'm hoping that, I think the world is hoping that that data set continues to improve over the next 2 quarters.
Han-Chin, I want to go back to your earlier point when you said Asia ex-Japan will possibly act as a buffer to any stock market crashes. I want to get your take here. Do you foresee other regions like this part of the world will take over and deliver better returns than the US in 2022?
So we think this year is really the time for Asia ex-Japan stocks to play catch-up. Valuation in the region is attractive, where Asia ex-Japan is currently trading at about 14 times forward PE, while compared to its peak valuation last year at about 17 times forward PE. And also in all of the non-ASEAN markets that we track in this region, which are basically the major markets in Asia ex-Japan, China, Taiwan, Korea, and Hong Kong, they are all trading below their 3-year average forward PE. And this is, of course, this is with the exception of India, which remains as Asia ex-Japan's most expensive market. And while in the US, S&P 500 is trading at about 21 times, and Nasdaq trading at more than 30 times forward PE. Hence, the main reason we see that why the other regions such as Asia ex-Japan is going to take over is really mainly because of valuations, especially when Chinese stocks have already been battered down very badly last year.
Under an inflationary environment, what investment style do you favor?
We prefer value to grow for momentum because we are expecting the pressure on inflation to result in a quicker rise in interest rates. And increasing interest rates will really force investors to reassess valuation of these growth companies, as future profits of these growth stocks will be worth much less in today's terms when interest rates are higher. And in contrast, investors will be more comfortable putting their money into value stocks because value stocks tend to provide more predictable earnings in the near future. And our value portfolios contain many cyclical companies that would benefit from inflation due to strong commodity prices, which will provide them with strong pricing power. And also, our model portfolio contains financials, which would benefit from wider margins due to higher interest rates.
You're expecting investor interest will rotate back to value stocks like what happened after the tech bubble 2 decades ago. Essentially, value stocks are those that pay a better dividend yield and or are undervalued. Where will you say we are in this value cycle now? Is it just the beginning, for example?
2 decades ago, we have a very strong run in growth. And then when the tech bubble burst in year 2000, value substantially outperformed growth. And the substantial outperformance of value lasted until the burst of the housing bubble in US in year 2007. And that was actually the peak of value stocks in US because housing and in US markets suffered. And then growth actually took over from 2008 until the end of 2020. While in Asia ex Japan, value outperformance have the kind of similar pattern, but it lasted longer since the burst of the US tech bubble and then peaked in 2012. And then growth completely took over till the end of 2020. So as an estimation, from year 2000 until 2011, value outperformed, then growth outperformed after that. So since the end of 2020, we have seen signs of rotation into value stocks, but we are only 1 year into the value outperformance since last year. So we are really talking about an early stage of a value rotation. And this has the potential to be a multi-year story.
Will we see an extreme outperformance of value stocks like what happened after the tech bubble?
I think we are unlikely to witness that kind of magnitude of outperformance observed during the burst of the tech bubble. And the main reasons being, if we look at the valuations perspective, valuations of growth stocks in the Nasdaq currently is nothing close to the levels observed during the height of the tech bubble. So take, for example, the 10 biggest Nasdaq stocks had a median forward PE of 60 times at the height of the tech bubble, while the current 10 biggest Nasdaq stocks, currently they trade at about forward PE median of 36 times. So the valuation is not so extreme between value versus growth to begin with. Nevertheless, we still think that the value outperformance is going to sustain. It's not going to be mild also, as if it's seen in last year's broad-based outperformance of value in Asia ex Japan. And as another example, if you look at US small and mid-cap value stocks, they actually outperformed the US small mid-cap growth stocks last year by 15%. So the performance is really quite significant in terms of the small and mid-cap value stocks, value space. This is perhaps not so obvious. Really, is because due to the spotlight on the Nasdaq performance last year, which was really driven by just a number of mega tech names, which is not kind of a broad-based outperformance.
Might the mega big tech stocks crash?
Well, I've heard in the past that when Apple first hit its first trillion market cap, this was, I believe, in 2018, that would be the end of the world, right? There were many naysayers who had been tracking, because it took basically a long time, 40 years if I'm not mistaken, to kind of get to this, near to this level. And no one has succeeded, and Apple was the first. And then Microsoft joined the club about a year later or 2 years later, and the world continued to go on, right? So to me, the most important thing is what products are these tech companies building in the first place? And what strategies have these companies adopted in their playbook to disrupt markets? And if the answer is that it's great product, methods of how the world lives will change, there's always great potential. And I don't think that just by looking at valuation itself can determine whether or not the tech sector is game over.
I'm guessing the game is far from over for the big tech stocks as new technologies are coming up. We're also talking about metaverse, for example, and of course supercomputing, 5G. I cannot help but think if there's a dip in share price of these tech stocks this year, you should still take the opportunity to accumulate.
Well, I feel that a disciplined investment approach is not to put all of your eggs in one stock or one sector. But a prudent way to go about it is to diversify it. Because the first option is effectively saying that, you take on all the systemic risks for a concentrated bet. Not only that, you are also exposed to the unsystematic risks for the sector. So, for example, if the tech sector underperforms, every tech stock will suffer as we are seeing it right now. So rather, I would capitalize on the benefits of diversification, and I would spread my bets across sectors.
Han Chin, you had pointed out Chinese stocks have been battered. So could there be tech stocks like Alibaba that are considered a value stock by your assessment right now?
From a quantitative point of view, the value metric looks better than its growth metric. Then I would classify the stock as more towards value as being to growth. Actually, many of the quite a number of these semicon related stocks in Taiwan and South Korea, they can be considered as value stocks because of their low valuations. But while for the Chinese big tech names, one example is perhaps Baidu, which has actually become cheap such that its value characteristics become stronger than its growth characteristics. And this and hence can be considered as a value stock, which is quite rare for a Chinese tech name. And similarly for Alibaba, it currently trades at a forward PE of just 13 times, which actually brings its value characteristic to quite a neutral territory. So loosely speaking, it is really somewhere between value and growth.
Why are tech-related stocks like the semicons you mentioned undervalued in this part of the world compared to the US?
Taiwan and Korea, in general, the PE ratios of those companies are generally lower. So when you compare with other countries, they're relatively speaking, they become cheaper. For example, Korea actually has an average PE ratio of just about 10 times. And over the past 10 years, actually, most of the time it has a PE ratio below 10. So it's really more region specific. I would say it's more country specific. So if you look at semicon names in Malaysia, they are not that cheap either.
You are now favoring banks, energy, and commodities. Give us a sense of how they are faring in terms of valuations.
For ASEAN banks, they currently trades at a price to book ratio of 1.4 times, which is right above its just slightly above its 5-year average, which is also a level last seen since pre-COVID. And after this is also after having rebounded from a price to book level of just below 1 time during the COVID crash. While for the energy and commodities, or we call it materials sector in ASEAN, they are still trading quite below their 5-year average forward PE levels, which we see it as quite undemanding valuations because we actually expect inflationary pressure and rising interest rates to benefit these sectors quite significantly.
Why are they still undervalued by the markets despite the reopening of economies and vaccine and booster rollouts?
There's probably a lag between the ASEAN markets and Asia and Japan markets, talking about the major markets such as Hong Kong, China, etc. They tend to react more quickly, and ASEAN markets a lot of times maybe they are they are kind of tightly held by institutional investors, and this could also and state investors, and this could be a reason why the share price tend to react quite slower as compared to the other Asia ex-Japan markets.
Well, thank you for speaking to me. That was Seng Yeow and Chan Han Chin, our portfolio strategists. For specific advice on which model portfolios are suitable for you, speak to your trading rep at Maybank, or if you don't have one, call our sales desk. I'm Noelle Lim on ASEAN Speaks by Maybank IBG.